mission is to improve the return of every asset that you have on chain. So we want to get to a point where you come to Upshift and no matter what asset you have in your wallet, you have the best risk-adjusted option to deposit your funds.
Making it more accessible to users, it does a lot if people are able to deposit in various assets and like also the more common ones instead of always having to pre-swap into the reference asset of every vault out there.
We also have the ability to essentially put a swap adapter in front of it so you can deposit other tokens in one click. It gets routed to a swap router and gets deposited. And we actually just completed audits for a new version of our vaults that will allow users to the vault to hold multiple tokens at any one time.
That is very overdue if we want to scale this industry into the trillions of dollars, because I think a lot of the kind of disproportionate returns you can still get in DeFi are subsidized by point speculation.
Part of the reason for starting Upshift was the assumption that your edge as a retail user is gone. You know, it used to be simple and, 5 protocols, immediate access, easy life. And now you have private deals and private incentive programs.
Welcome back to the Odyssey podcast. Already at episode 38 today. And we are joined by Alex from Upshift and August. Alex, how are you doing?
I'm good. How are you? Thanks for having me.
Doing very well. Great having you on. Could you start by giving a brief intro to you? How did you end up in the space and how did the idea for Upshift come about?
Sure. So I'm Alex, grew up in Europe and then studied in the US. And in my previous role, I was the head of DeFi for a hedge fund called Ledger Prime, where we went, this is back in 2020. So we went from managing a bunch of positions on a Google spreadsheets with manual inputs all the way to progressively building data systems and positioning management systems, which led to the incubation of first August and then Upshift as we can talk about. So Upshift is a vault management platform and August is an on-chain prime broker and wallet infrastructure provider. And essentially Upshift is built on top of August in that the vaults are deploying capital via August accounts. I could pause there. We can dive into the details.
Yeah, I think what sets you guys apart from a lot of other Vault Curator and like Vault Curator aggregation protocols is that you have August underneath. So maybe it would make sense for our audience to better understand what August actually does and how that enables you to build Upshift and to offer these vaults on there.
Yeah, sure. So there's a couple of parallels to August. For the institutional TradFi-minded folks, you can think about Hidden Road but on-chain, or Galaxy but on-chain. And for the more DeFi-minded folks, you can think about essentially a Gnosis safe with more granular permissions and a bunch of OTC possibilities. I'll get into the details of what that means. So why Gnosis safe? Essentially, as an August account has different roles. And this is going to be important in the context of Upshift. So you can be given a trading key or you can be the full admin. If you're the full admin, obviously you can do everything and you can control the smart contracts that you whitelist and the transaction policies that you have. If you are just the trader, you can only trade within the specific confines of what you're allowed to do. And then on top of that, with August, we support OTC loans, OTC options, and a couple of other products as well. So in the most complicated scenario with August, an institution can come with a bunch of USDC, put on a position on Uniswap v3, on Ethereum, another position on Aave on Plasma to be topical, and then get a loan against their combined position. So the account is cross-chain and the whole risk system is cross-chain as well. So essentially, August serves as the custody provider for Upshift vaults. The way this works is user deposits in Upshift. This is an ERC4626 smart contract. You deposit $1 at day 0. It issues you one, Upshift USDC as a receipt token, and then that $1 is moved to an August account. Now, I think what's really important here is what are the restrictions and the controls that are applied on whoever is curating this vault. And so, as we're seeing the space get vaultified and many providers start launching vaults, I think the difference with us is that it's very clear that in the context that I described earlier, the curator is given a trader role, but the curator cannot whitelist things. And so if you are the curator and we work with, and the partner is an asset issuer, call it Athena, there's a clear approval process to allow you to trade or interact with a new smart contract. So you can't just arbitrarily go and deploy funds to a protocol without asking for approval and whitelisting.
Okay, but like once you have your vault live, you can modify these permissions by request. So like it's not a static vault, right?
Correct. That's correct. So that's where we are also slightly different to other providers, is that we're very quick to integrate these things, but we do integrate every single function manually. And that can be, a positive and a negative. It's definitely a positive for security. It's a negative sometimes because we've had examples where Pendle will change their swap router. You go interact with Pendle, you effectively interact with the router. It's a single address that then allows you to buy whatever underlying market that you're trying to buy. And so they'll make a modification that you think that you're integrated with Pendle, and then the transaction doesn't go through and it's flagged as not whitelisted. And it's happened a few times where they've just changed their wallet, their router, which, while annoying in the short term, highlights the system that effectively, if their front end gets compromised or if the smart contracts get swept behind the scenes, we're controlling for that.
I just shared the screen. So if you land on the deposit page on Upshift, you see a bunch of vaults. Can you briefly explain who these strategists are, where they are sitting in the whole workflow, and just like how the capital flows if I want to deposit into one or the other of these vaults?
Sure. I would say there's a couple of buckets of vaults. The first and most basic one is pre-deposit vaults. So in this context, nothing really happens with the funds. This is more of an ecosystem development play. In certain instances, once the ecosystem is live, then the vault becomes more active. So in this context, generally the vault doesn't charge management fees or platform fees because it wouldn't make sense to have essentially a negative yielding vault up until the point where the underlying ecosystem is live. Then you have more traditional DeFi vaults, in general, in partnership with an asset issuer. So we have 2 vaults with Kelp. The goal here is to, maximize yield on RSETH. And where do curators sit in the workflow? They are really the ones that are, coming up with the ideas of the best capital allocation for the vault. And essentially Kelp has, or the quorum of admin has to approve any type of new strategies. In general, no individual actor can act alone. It's either, a 6 out of 9 multi-sig or a 4 out of 6 multi-sig, but in no scenario can the curator just, make modifications on their own.
So somebody from Upshift or August is also on the multi-sig, or?
Yes, in general, yes, we are. And again, we're minority. Kelp is minority, and the curator, in this case, I think you're looking at K3, is also minority.
Yeah. So essentially, in the case of the Kelp vault, what they are doing to maximize the yield is just looping RSETH
right.
in most instances, if I understand it correctly.
That's
so
right.
What you guys are doing is you take like reasonably complex, but also like reasonably transparent DeFi strategies, put them into a vault, and just enable access for everybody to deposit into them, right?
Yeah, absolutely. I think what's the interesting parallel here is how was DeFi in 2021 versus how it is now. In 2021 you had 3 protocols on Ethereum mainnet, and so anybody could just deposit in 5 clicks.
Yeah.
Today, with the proliferation of chains and ecosystems and incentives moving around the block, technically a user can do that, right? But there's also, it used to be accessible to everyone. Unfortunately, there's now, while everything is decentralized in theory and transparent, there's a lot of business development that happens behind closed doors. And so, an ecosystem team will coordinate with asset issuers to incentivize them to move to their chain. And so by essentially delegating your assets to a vault manager, you're letting them do the work for you.
Can you dive a little deeper into these different curators? I noticed first when I was in Denver in February for ETH Denver that suddenly everybody either became a vault curator or building infrastructure around vaults. How are these different curators and strategists vetted? And yeah, just like how from a depositor's perspective, if you're not necessarily a super sophisticated institution, can you assess and manage risks? Because from like I'd consider myself a DeFi power user. Still, like I recognize only some of the names on the Upshift front end. Like these really well known ones that I think kind of everybody has seen around is like MEV Capital. Yeah, like everybody's heard of them. But like, how are these people curated? And yeah, who can open up a vault? Is there any type of qualification you need?
Yeah, it's interesting because so there's different profiles of curators. Some of them are more suited to point and click strategies to go do a loop on Aave. Some of them are more quantitative. So, MNNC in this context is doing market making on Injective. It's fully systematic. And so it's not the same type of skill sets. Because we spun out Upshift out of August, a lot of these clients were actual clients of August. And so we've seen them operate. And so what's been interesting is that we have active experience working with these people, and we've been able to develop trust with these people to see how they operate. And then, of course, it's not just our choice, right? We have opinions, but ultimately it's the partner and the asset issuer that decides who they want to manage their vault.
Is there any vault that you find interesting in particular right now? Maybe in terms of the underlying strategy or like the risk return profile?
Yeah, the Maxi USR vault has been working pretty well. It's featured at the top. And what else has been working well? The Kelp vaults, these guys are really, really on it, both curators. They are always asking for new stuff and pushing us to deploy to new chains.
Oh, interesting to see. Oh, that's still the ongoing points program of all the restaking projects. I still remember the easier days in DeFi last year when we were all farming Eigenlayer and Karak and Circuit and Kernel, etc.
Yeah. So some of these things, I will admit that we might have forgotten to take down a logo, but some of these things are like they're still liquid Eigen incentives, right? So yeah, it's still happening.
Can you explain what Meso is? Like both the chain and like the token? I've never heard of that one.
Yeah, so Meso is built by the same team behind TBTC, Thesis Bitcoin. They're building a Bitcoin layer 2 and essentially trying to. So the comparison between them and the other wrapped Bitcoin providers is that they're actually decentralized. The way that TBTC is minted is through a network of validators that secure, like, observe the Bitcoin chain and then mint the TBTC in a decentralized way, rather than locking up your Bitcoin at Coinbase for CBBTC. So that's for TBTC, and so they've built this chain that is progressively launching, that essentially is positioning themselves as the Bitcoin bank. So you can deposit TBTC to mint MUSD, which is Meso USD, and then it's extremely low borrow rates. The caps are still pretty low. It's still pretty early days, but the goal is essentially to be able to use your Bitcoin productively.
Can you explain how the yields are being paid out, especially for vaults like this? I mean, you have a 30% target APY, so will you just receive more up MUSD, or is it value accruing, or is it paid out in any other asset?
It depends on the case. In this instance, I believe it is compounded into the vault, if I'm not mistaken, which is the case in the majority of instances. So the manager will, like the vault itself, will receive the incentives and sell them for more dollars or more of the reference asset. We do also work with Merkle and other rewards distributor providers to have targeted incentive campaigns. In this case, then the user has to the receipt token holder has to go and claim the incentives themselves.
Nice. So is it, in terms of the asset flow, is it USDC in, USDC out, or do you have to swap into any other asset beforehand before you can deposit into a given vault?
So by the ERC4626 standard, every vault has a reference asset. So in the case of the Kelp vaults, it's RSETH. In the case of the USDC vault is USDC, and we also have the ability to essentially put a swap adapter in front of it, so you can deposit other tokens in one click. It gets routed to a swap router and gets deposited. And we actually just completed audits for a new version of our vaults that will allow users to the vault to hold multiple tokens at any one time, which is better for slippage. In particular, if you're going to go, let's say you go LP, USDC, USDT, you don't want to force people to deposit all of it in USDC to then have to swap back into USDT and provide liquidity.
Yeah, like what I like about some DeFi project that I've recently launched, for example, like Infinify, it is you can just put in USDC, gets converted one-to-one. So like you don't incur any other friction in terms of having to swap into some more exotic assets or incurring a lot of swap fees or slippage on there. Also for stuff like, I think it's one of the Superform lending aggregator vaults or like Gauntlet, it's just very easy to have like USDC in, USDC out. So if you have a more complex DeFi portfolio, maybe with a lot of looping positions that you want to have like easy capital on the side to unwind, I just like put the rest of it into one of these vaults where I can easily withdraw it. I mean, the yields on these vaults are not like insanely high, but you have a lot of liquidity advantages there. So I think that in terms of making it more accessible to users, it does a lot if people are able to deposit in various assets and like also the more common ones instead of always having to pre-swap into like the reference asset of every vault out there.
Yeah, absolutely. That's definitely for the vaults that are not available here with a swap product or swap adapter in front. The next iteration is definitely to be able to deposit in one click. It's the case for the majority of the vaults, but for the one that is not, we're actually also working with Layer 0 to integrate their OVault composer, which will enable users from any chain, any Layer 0 supported chain, to deposit, and it feeling like a native one-click experience. So if you're on Arbitrum and you want to deposit to a mainnet vault, you effectively don't see the difference, minus a little bit more latency, but you deposit to mainnet. The deposit sends a message to mainnet, and the receipt token gets sent back to you on your original chain.
Yeah, I think that is actually a very underrated unlock in the whole user experience of DeFi. Like it's everybody who's building these curators or like strategies or whatever and tokenizes them and the infrastructure, they, in the past, it seems like they have always assumed that every one of their customers is like one of the top 100 DeFi native power users, which is just not the case. And even if you are amongst the customer segment of DeFi power users, it is just annoying if you want to deposit into some vault, you have to execute 10 transactions beforehand to like maybe send something to a new wallet, bridge it over, swap it into some weird exotic token where you incur like 2% slippage on a stable coin or whatever. And I think that makes things a lot easier to have that natively integrated.
I guess, and because it's my job to do customer discovery at all times. How would you value having even walletless experience where you set up your email password and we spin up a virtual wallet behind the scenes?
I think that for the people who are already very active in DeFi, I don't think it would make a big difference. So like once you're always accustomed to like managing your wallets, spinning up seed phrases, etc., it's not a huge change. But I mean, especially for August, I guess you guys are a little more positioned to also appeal to the crypto curious TradFi folks. And I think for them, that would be quite a big unlock. So, yeah.
Interesting. I'll take notes.
Nice. Maybe to dive a little deeper into the economics behind Upshift, your guys' revenue models, and how everything of that works. So you have a staking feature. Could you briefly dive into that? At how do you stake these receipt tokens
Yeah,
on the vault?
that stage is actually on the verge of being deprecated. It's only there for a remaining few users. Um, it's from the days where we have two old vaults on Avalanche chain um, that predate the kind of Merkle incentive type behavior. And so we had a pool two in the old way where you take the receipt token and stake it for more
Oh,
incentives. So
okay.
that's actually going to go away.
Nice. So what's the revenue model of Upshift? Because I saw that
Sure.
for a bunch of the vaults, there's no performance or management fee. So how do both the strategists and curators and how do you guys make money?
Sure. So yeah, there's a combination of platform fee and management fee when it makes sense. Um, in general, we are very commercial in letting the vaults ramp up before we introduce any kind of fees. Um, so you can see here again, I'm discovering this with you on the spot. But so here you have zero platform fee, but you will eventually have a performance fee once the vault has reached a certain milestone capacity. And I mean, that's pretty much it. I think then we can then play with the levers again. We generally, as the infrastructure provider, align on what the partner or the issuer wants to do. And then from a business perspective, you want to put the fees in different buckets depending on the use case. As I mentioned previously, it doesn't make sense to have an incentive, a platform fee that is recurring every day on idle assets that are
Yep.
sitting in a pre-deposit vault. In that case, you probably want to take a revenue share on the incentives that get generated. But on a pure liquid yield dynamic strategy, then it makes more sense to have a performance fee, but perhaps less platform fee.
Yeah. So are all accruing fees already priced into the target APY?
Yes.
Nice. That makes sense. So you guys have a points program going on right now. Can you dive a little deeper into that? Are there any specific vaults or actions on the platform that you want to incentivize? And what is the role of the potential Upshift token going to be going forward?
Sure. I can't give too many details on any tokens per se, but right now we are incentivizing almost every vault in an equivalent way. We're also incentivizing composability actions. So if you go, we're pushing hard to make our receipt tokens composable across the space. So, you can deposit into Upshift USDC and then take the receipt token and borrow against it on Morpho. So we're monitoring that and assigning points to that as well. And yeah, other than that, I mean, obviously we want to, reward early users when the time comes. So that's the general framework.
Very nice. Is there anything you can talk about regarding the functions and use cases of a potential token down the road?
Yeah, I think I'm very inspired by the Curve VE token model with a few modifications. I think the problem with encoding everything on chain is that you are wedded with your economic model for 4 years, and it's a really easy way to kill your project if you make one mistake. And we've kind of seen that evolve over time, right? Like we went from a world where everything was fully on chain in 2020. The inflation and the whole tokenomic model was on chain from the very beginning, for better or for worse. Like some projects had too high of an inflation and that killed them. To a world where you have 17 seasons of points, where the team effectively has way too much control to change the rules of the game at any one point. And so we would like to converge to something that is somewhere in the middle, where the voting is on chain, but the mechanics are not governed by smart contracts. They're governed off chain. In order to essentially create an ecosystem where, as a partner or as an asset issuer that wants to run a vault on Upshift, you have an incentive to vote for yourself to assign yourself your vault future incentives and kind of be a bigger part of the ecosystem.
Yeah, I think that makes a lot of sense. Talking of DeFi integrations, which you just mentioned briefly, so I guess that is the list of all the platforms where you can use Upshift USDC to like further play with money Legos, right?
That's right.
Yeah. Um, I'm trying to ask this question in some way or form to almost every project I'm having on the pod that is DeFi related, because I'm quite interested in like more systemic risks for DeFi. And if you look at the rise of like a lot of kind of vault curation platforms and Pendle PTs, etc., platforms like Infinify, which then tokenize these Pendle PTs and give you a receipt token again. And then you can go and use these receipt tokens elsewhere. So you're ending up in a state where you don't have any under collateralization, but you have a lot of cross collateralization. So just if we kind of think this a few steps further, if we assume we'll have like a complete hyped up market frenzy in a couple of months again, where people are very eager to deposit into DeFi strategies that are far out of a risk curve, maybe facing some liquidity constraints. Is there anything that you consider concerning, either right now or maybe in the future? And how are you trying to navigate that with Upshift?
I agree with your concern. It's something that we take very seriously. It's unfortunately not a simple answer. The answer I can give you is we're playing the long game. So we don't really want, it's never good for anyone to have a vault that goes crazy and then that has 80% redemptions in the span of 2 months. Even internally for the team, like, you work hard and then you get a temporary dopamine boost and then the
Yeah.
dopamine boost goes away.
I mean, it's a little bit similar to these billion-dollar Pendle expiries. I mean, it essentially it doesn't really collapse the TVL because it just gets rolled over. But I do think that like every time that happens, also like when I talk to people who have like actual size in DeFi compared to myself and are in these Pendle pools with millions of, if not tens of millions of dollars, like it must always feel like a quite concerning hour to be around during that time.
Yeah, for sure, for sure. Although at least for Pendle you can roll, right? Like the money stays in the underlying. I think on the risk side of things, so August was originally built for to bring back lending into the ecosystem, right? Like we raised our seed round after FTX blew up, and after we saw the collapses of BlockFi and Celsius, and I was on the other side in my previous role of being a borrower from those guys, and so there was no risk management. And so we spent a lot of time in the August underwriting process to monitor fund flows and in particular liquidity holder concentration. You would be very surprised to see the TVL or like the share of deposits on Aave by the top like 20 holders. It's like 75% of the TVL, right? And so, even so, 20 evenly distributed holders is very different from 5 individually distributed holders. And you kind of see it in extreme scenarios where Justin Sun decides to pull a bunch of liquidity from an ETH market, triggering cascading redemptions on EtherFi, right? So we pay a lot of attention to that, and it goes into our underwriting model, and we have scripts that are pinging and updating that data on a daily basis. That's kind of like the risk management side of things. And obviously it's not perfect. It's not a hard and set rule. There's a very big difference in the granularity between individual assets. And so, we spend a lot of time thinking about that. On the, not so much pump and dump, but flows that come and go, and kind of like implicit leverage into the system. We pay a lot of attention to idle liquidity in all of these vaults. And so you can see on Morpho vaults or on Earn vaults, what are the capital buffers allocated to instant redemptions. And so that also factors into our our underwriting models. And finally, in a number of instances, at least on the August side, we integrate as primary minter or redeemer with some of those protocols. So, Athena is not really necessary anymore because they're so big, but very early on, it was pretty important to know that you could just ping the redemption and you were whitelisted to ping the redemption primary. And so that's some other factors that plays into that.
Speaking of the distribution of like large holders, what type of market share they make up, and kind of the evolution of sophisticated players in DeFi in general. Since you guys are very much at the forefront of interacting with these people, how would you say the kind of power user base of DeFi has shifted, let's say, over the last 24 or 12 months? Like, is it now completely dominated by very sophisticated funds with like algorithms and everything in place to automatically rebalance things? And like, how would you say your edge as a retail power user has evolved or deprecated over time?
I think part of the reason for starting Upshift was the assumption that your edge as a retail user is gone. It used to be simple, and 5 protocols, immediate access, easy life. And now you have private deals and private incentive programs, and a protocol will say that their community airdrop is 6%, but really it's 2% to retail, and then the rest is tied up on private deals that they've promised for a year to a bunch of funds. And so in the classic S curve of the great bundling and unbundling of technology, we unbundled everything initially in DeFi, and it's now getting rebundled with intermediates whose job it is to do that full time. And that's why we have curators. And so they are more or less sophisticated, but it is a full-time job to do this. And so it starts to make sense to give up a little bit of performance fee or a little bit of platform fee to abstract that work away, and I would consider myself also a power user, but I'm so behind on managing my own portfolio because things move all the time. I mean, you're seeing it with these plasma incentives, right? They're running for 7 days, which is the right thing to do from the plasma perspective, because then they're going to reallocate incentives elsewhere to, push people to move their funds somewhere else, and kind of trigger activity on the chain to make people test a bunch of protocols. It's a full-time job to do and manage that next to your normal job. So that's the reason for vaults.
No.
I will also say that one thing that's been interesting is, well, first, when we raised our seed round, saying DeFi was a curse word, right? So we were very far from the institutions that are coming. It was a select group of DeFi funds that had already been there and continued to grow over time. What's been interesting is that now these institutions are all wanting to run vaults as well. And so what used to be private users on the August side are now funds that want to tokenize themselves because, the regulatory regime is more friendly and it's added distribution for them. And we're also starting to see real institutions come into the space, and vaults, fundamentally, what is a vault? It's a mechanism that allows you to tokenize any type of strategy, right? Like pre-deposit vaults are all fun and games, but really you want to tokenize traditional assets. And so we are building the infrastructure to price, manage, and handle the permissions to manage trillions of dollars at scale. And so as we start, as we move up market, now you start talking to or asking the questions of what are these digital asset treasuries going to do to manage their funds? But that comes with a whole new set of constraints, right? You probably want to have KYC only vaults. You probably want to have the receipt token held at a qualified custodian because that's their requirement. And so that's kind of the evolution that we've seen happening in our conversations.
Would you say you, as a power user on an individual level, there's any edge left in terms of like different strategies with potentially higher risk profiles or liquidity constraints that remain largely inaccessible for like bigger players and these vault curators?
Yes. There's kind of a gap, right? Like if you have 5 figures, there's a lot of edge in having time to, go long perps on one new DEX and short perps on the other new DEX and collect points on both sides, right?
Yeah, I noticed that. I mean, right now in the DeFi dojo, we have a yield farming competition going on, and in the past, there usually were different tiers of portfolio sizes that you could kind of participate into. And this time it's everybody has to compete with K starting capital. And pretty much everybody who is charging ahead is just doing funding rate arbitrage on like rather illiquid, low open interest pairs like some Solana meme coins, or just periodically shifting and exploiting these super outsized opportunities like on Aster DEX that we've seen a few days ago.
Right, exactly. You can't do that with $1 million though, right? Like, and so that's where there's definitely some edge there in being active at that scale.
And then on the other hand, like, what is the edge you can usually gain through private deals? I mean, for the average DeFi user, I guess they don't really know how these are usually structured. They have never faced any single one of them in person. So like, how do these usually work? What are the kind of lockups and what are the advantages you can get out of these?
In general, you will commit your TVL for a set period of time, whether it's the Vault's TVL or your fund's TVL or any type of large bucket, and you will get additional incentives that you can claim at the end of the process. That's one option. And that's the most extreme, inaccessible option for retail. I think the other one that is kind of mispriced is the lack of predictability if you're retail, because we have conversations with all these ecosystem partners. We have some sense of visibility into what their plans are and what they're trying to achieve. And in some instances, we actually work with them to bootstrap certain liquidity in certain protocols that they're trying to incentivize. And so we know what's coming, right? And the curators know what's coming. If you're a retail user, there's no notification system on chain, right? Like you can't just get an email that says the incentives have run out. And so you have to pay a lot closer attention to these things moving around.
No, no, fully agree. Maybe to close the circle with all of these vault curators. Can you shed a little bit light, because I mean, you guys are interacting with a lot of them. What does the competitive landscape look like right now? Like, who's competing with whom on the strategist side of things? Maybe what are the differentiators between them? And maybe if you want to also dive into the competitors for Upshift, and feel free to drop some spicy takes.
I'm not the trash talking type, so I'll try to stay positive. I mean, fundamentally, I think the space is big enough for everybody. Like if you think about global yield markets are supporting $100 trillion today in TradFi. And so a big fraction of that, and eventually all of that is going to move on chain. I'm not too concerned with competitive dynamics right now because, and you can see it with stablecoins, the blockchain is a better infrastructure system to manage those things. And so as you get stablecoins that attract assets on chain, those assets are going to have to go somewhere. Those savings accounts are going to have to exist, and will be there to support that infrastructure. And on the competitive dynamics, I think I would just encourage users to. A lot of it is unfortunately not very fun, and kind of important for due diligence. But I would encourage all users to go read docs and kind of understand. I've described how August works and kind of the controls that happen there. Some systems are built fully on smart contracts, which are arguably more decentralized. The problem is it takes a lot longer to integrate a new protocol, right? If you have to build a new adapter and get it audited every time something new happens, it's slow. And then on the other side, you have systems that are fully custodial, where the vault is essentially sending money to an EOA, and the EOA is managing the funds. You just have to be aware of what risks you're taking. And sometimes centralization is necessary. I'm not going to say that if you have a strategy that is using centralized exchange to hedge impermanent loss or hedge with options, there's no avoiding the fact that you're going to have some custody provider somewhere that's holding the funds. But just being aware of the trade-offs are, because all the crypto users that we interact with have very differing opinions on what enough decentralization means.
Well, also, like, if you read through these docs, I mean, I think that the best practice would just be to have all the wallets linked, where you can double check what kind of transactions and strategies people are doing. I mean, on the other hand, you obviously would give up part of your edge as a strategist by doing that, and I fully see the rationale that there are certain strategies where you want to keep it at least a gray box. For example, like I think Stream Finance is a good example for that. Like, they have a bunch of public wallets where you can just put it into dbank and you can see exactly what they're doing. But obviously they're like also running some stuff on centralized exchanges. At least they did that in the past. And I think there are some like more wallets that are into liquidity deals, etc., that are not public. And I mean, it's very reasonable to do so. And I mean, stream finance overall, it's like probably on the more like giving up custody end of the curve, because you essentially let them manage your money, and it's not just some like lend aggregator as like the some of these gauntlet or superform vaults. But yeah, like personally, I just find it, even as somebody who is, I would say, pretty native to like most DeFi strategies and mechanisms behind that, to really give it a reasonable risk assessment. So like, for example, like that results in a rather like, yeah, diversified allocation behavior. Like I would feel quite uncomfortable to put more than like 10% into of my stablecoin portfolio into any vault where I do not really understand what they are doing. Like I think there are some simpler models like Infinify, which is like just like essentially putting duration on top of Pendle PTs. So as long as you're familiar with these Pendle PTs and you trust the Infinify team, how they curate these PTs and like risk assess them, and you have like these senior and junior tranche models in essence, then I think there you can be a little more liberal with risk management. But everything that like comes towards like gray zone vaults, maybe like I think Avant is another example that gained a lot of traction over the last couple of weeks. Like, yeah, it's the yields are attractive, and like I think especially like unless you have a huge portfolio, I think it sometimes is worth to just put a little bit into it and to like learn it by doing. At least for me, that has helped a ton in the past. But yeah, I think we are still quite far away from being able to have like standardized risk frameworks. But yeah, maybe transitioning to the path ahead. So what are you guys looking forward to at Upshift, let's say over the next 6 to 24 months? And what do you expect going forward? Because like a lot of protocols are always talking, yeah, like we are going to bring trillions of dollars on chain, but very few people are actually talking about, okay, that is step by step how we'll get closer to that goal.
This is an interesting question because we spend a lot of time thinking internally about the things we should not do. And one thing that we will not do is we will not tokenize assets ourselves. So we exist and we start interacting from the moment that an asset is on chain. So in that context, it's stable coins and other assets' responsibility to bring fiat on chain. And then we will grow with them and we'll like provide additional services to them. But what we're excited about, we're releasing a V2 of our contracts. Actually, it's rolling out today and for upcoming vaults over the next couple of weeks. The mission is to improve the return of every asset that you have on chain. So we want to get to a point where you come to Upshift and no matter what asset you have in your wallet, you have the best risk-adjusted option to deposit your funds. And so that comes with all the transparency that is required. And so that means being able to support assets, whatever chain they're on. So expansion to other chains. That means as close to one-click deposit as possible, hence the integration with Layer 0 and integration with swap adapters, etc. And eventually even the integration with embedded wallets and fiat service providers. And eventually we're excited to start working on real institutional vaults that provide something different to the ecosystem beyond just points farming and PT speculation. There are some interesting TradFi use cases that we're exploring, especially in the world of payment finance. Uh, if you're a credit card issuer and you need to settle with Visa, you need to have 4 or 5 days of idle liquidity. So you need a revolving credit line to be able to satisfy those redemptions. So these are the use cases that are second order derivatives of stablecoin options that are super interesting to us.
Nice. Yeah, I think like expanding the tail of assets that are accessible for these walls would be one thing that I'd find quite interesting, because like you have a ton of competition out there for USD stablecoins, BTC, ETH, and like a few Sol and hyperliquid vaults out there, but everything like further out the risk curve is kind of not to be found for most vault providers so far. So I think there's, I mean, in absolute numbers, not a huge amount of capital to unlock just because the market cap of these assets is obviously much smaller. But I think in terms of user acquisition, you could build out to quite a few more user groups there. And also what you were mentioning in terms of bringing somewhat like mixed or TradFi strategies on chain, I think that is very overdue if we want to scale this industry into the like yeah trillions of dollars, because I think a lot of the kind of disproportionate or like alpha returns you can still get in DeFi are subsidized by point speculation. I think like Pendle PTs are obviously the most apparent example for that. And while this will play a component in the future as well, I think there is a point where you would severely dilute that. And I mean, it's a little more cyclical than other strategies that are available on the TradFi side of things. So yeah, I think that would be a great sign of the maturation of the space. And
Yeah, I mean, I'm not going to spend the next 10 years of my career doing incentive farming. At some point, we need to, we've built all the systems. Now the go-to-market for any asset on chain is pretty clear, right? Like you want to you want to have a vault to have a yield-bearing version of your own product. You want to have composability on lending markets, and you probably want to have a PT fixed yield option. But the underlying needs to become real, right? And so I want to get to a point where, you are putting tokenized S&P 500 in the vault, or you're tokenized, private credit in the vault. That's where things get really interesting and actually start to offer enough products that you can run all of your personal finance on chain without being fully correlated to just, crypto hype cycles.
no more Arbitrum drip farming in 2030.
Yeah, hopefully.
Was great having you on. I think Upshift is one of the like more interesting players in the whole vault space, and I mean, you guys have been able to gain quite a bit of traction in TVL over the last couple of weeks and months. Is there any other topic you'd like to cover before we hit the hour, or any last words you'd like people to know?
No, I'll just ask for feedback. Again, I'm doing customer discovery at any point in time. So if our docs are not transparent enough, if our app is not transparent enough, please come and yell at us and we'll make it better.
Very nice. Where can people find you, and where can people find Upshift? And yeah, let me know any links I should include in the podcast description.
Sure. You can find Upshift at upshift.finance or upshift_fi on Twitter. You can find me at Elkrief, and you can find August Digital on Twitter and at augustdigital.io. That's it.
Very nice. Was great having you on, and maybe see you in Singapore next week.
Sounds good. See you there.
Have a good one.
Bye.